Hello everyone. My name is Ngoc Nguyen. I'm the Vietnam-based correspondent for DealstreetAsia. So I have the privilege to moderate this panel today. We have Paul Ark from Digital Ventures, from Siam Commercial Bank, not the Digital Ventures elsewhere in the West, and Semina from Rakuten Ventures, Aditi from Grab Ventures, and Andre from Systema Asia Capital. Unfortunately, initially we have Erin from Air Asia, but she couldn't make it today. So yes, we got to hear about the corporate investment today in Asia, especially in Southeast Asia, from the top players in the industry today. First of all, I think that you would like to hear from them about what they are doing. So please give a brief introduction about you and your firm.
I'll start on my end. Okay, my name is Paul Ark. I am with Digital Ventures, which is the fintech arm of Siam Commercial Bank in Thailand. So Digital Ventures does a variety of innovation-related activities, but one component is the corporate venture arm of the bank, which I manage. We are a global investment fund, so we've invested in, I believe, 9 or 10 different markets around the world, predominantly fintech, but I will say we will look at anything that would intersect the financial services world. So it might include things like deep tech investments. It might include things that we call, say, fintech adjacent. So it might be commerce or some sort of service that involves a payment or insurance or remittance aspect. Yeah, so that's what we do.
Hi, my name is Seaman. I run a corporate venture capital firm called Rakuten Ventures. It was founded in 2013 by me. It's a $300 million fund. Even though we're a CVC, we're a financially focused CVC, and we invest in anything that has a good technical bend. We were early investors in Gojek, Carousel, some Coda payments and vCents. We look at invest in and look at global opportunities, and we've been doing this, as mentioned before, for the past 6 years.
Hi, my name is Aditi Sharma. I head up startup investments and programs for Grab Ventures. Grab Ventures is Grab's venture building and venture investments arm, and we look at startups both in the region and globally to see how we can work with these startups and solve the everyday challenges of Southeast Asia users.
I'm Andrei Cherebinin. I work for Systema Asia Capital, which is GP for Systema Asia Fund. It's a rather big European fund targeted at India. And Systema is a big chaebol in Russia, running more than 1% of GDP of Russia. And we know how to bring company, both B2B and B2C, from zero to a New York Stock Exchange. Actually, that's what we export to, is this expertise to India.
Yes, thank you. So today, I think I will give you a brief overview of the structure of the panel. So I think we might go through like how the thesis and the structure of corporate VCs work in this region, and also there you will have some projection for the sectors and trends that you'll see going on in the region, and some view on exits too. So as we speak about corporate VCs, I think it's been conventionally thought that the funds will try to only invest in the sectors that can align with the parent firm's strategy. So is this still true? I think I will go with Semin first.
I think that was a going theory, but I think if anything, in the past 3 or 4 years of really big corporations have shown you that mold is being broken very, very quickly. I think the best kind of thesis breaker in this perspective is guys like SoftBank and indeed Rakuten Ventures, where we've invested in anything in relation to commerce, but also we've done ride-hailing and whatnot. SoftBank obviously has their own kind of cacophony of investment theses that they've built out. I think more and more, a lot of the corporations are finding out that through these investments, it's a very viable and durable way to abstract value and grow that value through and through.
And for Paul, so as the investment arm of Siam Commercial Bank, then it's quite like sector focused. So you're looking into fintech and verticals that can supplement for fintech. Is that all, or are you also exploring anything else?
So when we look at technology, we look at it from maybe two general time horizons. One is the near term, so anything that might impact financial services in the near term. So will this technology enhance or disrupt our lending business? Will this impact insurance? But if we look at sort of a longer term time horizon, which as a corporate VC that invests off balance sheet, we don't have an end of fund life, so we can actually take much longer time horizons. I believe when SG Innovate was up here earlier this morning, they had made this comment that because they don't have an end of fund life, they can look at investments that might take a much longer time period to impact or gestate. So if I look at technologies that might impact financial services, not in the next 3 years, but maybe say a decade down the line, that gives me the ability to look at technologies like maybe geolocation, maybe quantum computing, maybe virtual reality. And in some of those cases, we've started to make some of these investments with the intention that we may not be able to incorporate it directly into our business today, but I think as these technologies morph into something financial related, and as banks morph into something that starts to resemble more tech companies, I think you're going to start seeing convergence. So we do have a bit of a thesis that it's related to financial services. It's just a question of trying to figure out how tenuous that connection will be.
Part of what you have said is the time frame of the fund. I think we will come to that a bit later on the exit part. So continue with the team on the verticals and the segments related to the parent strategy. So for Grab Ventures, RDD, right now Grab has mobility, logistics, fintech. So as the company is trying to be the regional super app, what are the new themes that you are exploring and you think that would fit into your ecosystem?
So I think in terms of investments in general, we would back founders who are solving the needs of Southeast Asia consumers using tech. That's the general. In terms of investment themes, there are two broad areas. One, we are looking for startups that can help us complement our existing core business. That would mean core business of transport, food, payments, financial services, groceries, logistics, and auto commerce. So that's one part. The second type of new investment areas that we are also very interested in is tech capabilities. That would include themes like IoT, AI, in mobility, as you mentioned, electric vehicles, autonomous driving, autonomous delivery. So those would be the two broad categories of investments we are most interested in.
As you mentioned before, I think Grab said that Grab Ventures was looking to do like 2 to 4 deals per year. So do you think like how is the pipeline look like, and is there enough deal flow for your target?
So as such, we don't have a target to do a certain number of investments, but we do see ourselves doing 2 to 4 investments, strategic investments a year. I think in terms of deal flow, we are quite bullish on the Southeast Asia startup ecosystem. Not only the region, but we source good startups from this region, but also globally. So we look at startup investments in both geographies in that sense. An example of that would be the recent investment that we announced in Split. Split is a UK-based mobility roaming company. And as for most investments that we do, it always starts with a partnership. The intent of the partnership is to see how we can bring good ground transportation services to both the inbound tourists into the region and also our existing customer base in Southeast Asia that is traveling outside. So that's the interest from Grab's side. From Split's side, how the partnership works is we help them strengthen their core proprietary technology. We help them widen their base of supply and demand partners, at the same time also help them enter the Southeast Asia market. So those are the kind of global investments we would look at, and the pipeline is quite interesting.
Yes. So it seems like the majority of the panelists here are going after the model of a global fund, but with a base and a focus on Southeast Asia. So for Andre, a Russian company investing in a lot of sectors, how do you see the market and the deal flow in Southeast Asia and India? And do you think that Southeast Asia is also catching up with the dynamics in India?
I like India because India is big, everything is big. Opportunity is big, upside is big, problem is big. So we like big bets, we are Russians after all. We are not risk averse, so India for us it's like a core investment opportunities, because if it's like you do it properly and you help company to build up a leader in industry, it's quite a big chance that it will be a good deal out of it. But on risk return, Southeast Asia looks like more comfortable for many investors, because you bring company to $200 million valuation and it's a big chance you can sell it. India, liquidity-wise, is a different ball game. So you are build up a big leader, looking to sell it everywhere, reaching every opportunity. So I think it's like not a catching up. It will be two different markets. I don't see very much synergy between of them so far, but it both interesting markets with very specific ball game for venture capital space. That's what my thinking is.
In terms of the geography, so Paul, Digital Ventures has made a lot of investment outside of Thailand, outside of Southeast Asia. So you seem to be going far from home. So what is your assessment about the local market, the regional market? So for fintech, do you think that there are still not a lot of opportunities for your firm?
I'm glad that you attached my fund at the end, because I think it hinges, the suitability of investments in this region hinges on the specific strategy of the fund that's backing it. So for Siam Commercial Bank, from a venture perspective, we tend to look for enterprise-grade technology that sort of feeds our back-end operations. So, we tend to be not as consumer-facing when it comes to tech investments. So if I wanted to do, say, a digital wallet or some sort of, consumer-facing fintech, a lot of times I'll have folks in the bank say, oh, we can do that ourselves. Why would we want this one instead of that one? So if I say I want to do like a local lending startup, they'll sit there and say, well, how can they lend better than we can? Whereas if I say, oh, I have this interesting cyber defense technology, and they'll be like, well, we don't know how to do cyber. So it's like, perfect, then I'll bring it in. So for us, it's like, we have a harder time. We've looked locally and we've looked regionally, but every time we bring something that's very consumer facing, I'll always sort of get that typical corporate refrain, oh, well, we can do it ourselves. So that's why a lot of the technologies and a lot of the startups that we've actually wound up investing in are things that are more back office, back of house, enterprise grade. It cuts across multiple verticals within the bank. Because if I wanted to do an insurance startup, then I would probably have to talk to our insurance arm, and then they'll have any number of reasons why they may or may not be interested. So, and I think that's particular to our bank. So our strategy, I didn't set out to say, okay, we're going to invest globally and we're going to do these markets. We realized what our limitations were strategically and culturally. And we said, okay, these are the theses of technology. These are the theses that we're going to adopt in terms of our investment. And then we just basically go wherever the best technology is. So if we're going to do, say, quantum software, for risk management, portfolio optimization, then we just look at wherever, they're not a plethora of players in the world. There's a handful of players, and they're in a handful of different markets, and we just say, okay, we're either going to go to Vancouver, we're going to go to Melbourne, we're going to go to Washington, D.C., the few places where you might find this technology. And then we just invest in the company we like the best. So I'm in some of these markets just by virtue of the companies we invest in.
So it seems like it's still depending a lot on the strategy, the overall strategy from the parent group. So do you see, so this is the questions for all of you, do you see any conflict in terms of decision making between the parent group and you as a venture capitalist, like in a case that, you see this is a very attractive startups, but then the management from the parent group would say, no, we're not going to invest in them. Is there any case like that?
I mean, for me working in the Japanese company and then doing venture capital, that alone is a fundamental conflict in that there's a risk aversiveness that happens with culturally that happens in the company. And in many ways, the way that Rakuten Ventures have solved it is simply we own up to it. Is that if the board does not want to do it, we put our names on it and we make sure the company is a success. That's been, in many ways, the biggest alpha here. It's great that we can draw synergistic lines towards different lines of business. Like Rakuten Group has 60 or 70 subsidiaries. But in the end, we want to completely focus on the best companies, the best technologies, the best teams. And when we do that, then marrying that synergistic idea later on is a much easier task.
Anyone want to add to Semin's?
I think it very much depends what your mandate is. We are run by big corporate player. The corporate player is a GP, it's a major anchor LP, but at the same time we take external money, showing everybody that we export management capabilities and not linkage. No, we're not extension to our strategic arm of any our daughter companies or the corporate center. We have management experience, we want to introduce the management experience, and our LPs invest in our capability to do it properly in India, given our exposure to India from 2008. So it's like his colleague said, it depends, what is your mission is.
I'd like to add one additional aspect to that. I think to Saman's point, I'm dealing with decision makers that sit in a corporate entity in a bank, but as a Southeast Asian financial institution in the middle of this big fintech wave, I think as a bank we're going through a transformational moment. So the bank is trying to realign itself around what its strategy needs to be. As a result, there's wholesale reshuffling within banks. Either new departments are coming up, they're moving people around. So the type of decision-making process I might have had to deal with 2 years ago is very different than what I have to deal with today. I mean, I personally am on my 4th boss in 3 years. The composition of my investment committee changes every 6 to 9 months. So just when I get a sense of which IC members are going to push back on which aspects of which deal, then they'll cycle people out, and then it's a discovery process all over again. And every time we get a new president or a new head of whatever business unit, their agendas might change a bit as well. So for me, my decision making and my strategy is a constantly moving target. And I mean, that's just, it's a frustration, but that's just the reality of corporate VC in a sector that's highly evolving.
So among the four of you, have any received like external LPs, and how have they contributed to the operations of the fund?
Me. They yell at me, so. I yell back, that's the business, right? So, no, actually, we made we are first-time fund, so we are quite known in Russia and continental Europe. When we came here 2016, it was like quite a challenge for us, but like it's not rocket science, you know. I mean, like we been to India thanks to our colleagues, you know, from 2008, and we just inherited a lot of the experience. The issue is what we did. We immediately not immediately, but after 2-3 years, apart from this Europe things, Europeans are useless unless they have particular experience. For example, Germans in risk management, we definitely brought them to some of our companies, but we start raising in India. Because sitting in one boat, it's not like they're not consultants, they're people sitting with one boat with me. And I personally, because I'm just a single foreign partner, other partners coming from top-notch Indian funds, so I need like a little bit challenging them, so not to look as a stupid Gora, a stupid foreigner, yeah, to just, I need something like for in my back, you know, who will help me with their personal advice, you know, on how to do in India. And we start raising, the corporate center say, idiots, what are you doing? Say, why you need like external money? We'll give you all the money. We say, no, no, no. We need like somebody. So we raised in India, and now we raised in India more than even we raised in externally. And it's tough guys, like Gujarati, Rajasthani, Marwari guys, you know, they know what they're speaking about. And they are a great, great help. Wherever they say, they're always criticizing, they always say I'm doing wrong, but their substance helps me personally a lot, right? And this is like the situation. So when it's like somebody say, what do you prefer? Yeah, definitely I prefer a big check from some guys in Germany or Russia, Luxembourg. But at the same time, I really need like even a small check from India because it helps me operationally, it helps me to understand more and more what India is.
Yes. So let's focus on Southeast Asia for now. So there are an increasing interest from both commercial funds and corporates. So do you see it's getting more competitive? So IDD as a driver for expansion and innovation, do you see that valuation is getting higher? And for Grab, as you might invest in the early stage and until the Series A, B stage, are you gonna pay for an attractive investment by any cost?
I think, again, for us, would go back to the partnership, right? For us, it's a partnership first approach. We invest a lot of time upfront, and we also encourage the startups to do that with us to understand the value. So we would typically come in at growth stage, where not only the business model, the monetization is very clear, it's also about what is the value each side is bringing to the partnership. So the investment is really more a lubricant to strengthen the partnership and bring about more alignment. So from that sense, what valuation we come in at and how we value the partnership is really linked back to the first objective first.
And coming to the sectors, so a lot of deals in Southeast Asia have been in consumer internet. So what about B2B? So I see that Rakuten invests a lot in consumer businesses, but what's your take on B2B? Do you see any signal that B2B in Southeast Asia will get stronger and more attractive?
I think definitely with more developers kind of migrating back to their home countries, you will see more tech-centric companies starting up. For Rakuten Venture, we've invested in a multitude of B2B or tech companies based out of Southeast Asia. Like vSense is a computer vision company that has a global presence. Koda Payments is an Indonesian carrier billing company that has a Southeast Asia-wide presence. So for us, again, because we invest globally, we're able to do a real apples-to-apples comparisons with companies. And then we look at what kind of value and roadmap are they driving to. And when it ticks all those boxes, then we have much more confidence in investing in those companies.
How about you, Paul? So are you investing in both?
Well, I mean, a lot of our investments are fintech B2B. So, which has actually made it very challenging to find the types of investments we want here in the region. I mean, if I go to New York, it's very easy for me to find an entrepreneur who spent 10, 15, 20 years in a financial institution, sort of saw all the institutional problems, decided to come out, do their own startup. There is, a plethora of fintech VC funds that would invest. You don't see that as much in the region yet because most of our ecosystems here in Southeast Asia are less than a decade old. We have a lot of folks that are either in their 20s or early 30s or just out of business school, but we don't see a lot of those sort of corporate gray hairs that are saying, I am a senior VP in a big financial institution, I'm just going to jump out and do a startup, because that's an extremely high risk enterprise. There's not a lot of VC, there's not the wealth of VC money, there's not a lot of exit, so to leave a cushy corporate job and do a B2B startup is a very risky proposition. That, I think, will come in time. I think as the ecosystems in Southeast Asia mature and they hit that certain point in the life cycle, you are going to get people that are coming out saying, okay, I can solve this problem. I've been at Siam Commercial Bank or this such and such insurance company for 15 years and I know where the problems are. I think traditionally we've seen a lot of consumer facing, a lot of lifestyle, a lot of e-commerce, because I think those are the types of companies that is easy for a very young first-time entrepreneur to start. Fast forward 10 years and these are all serial entrepreneurs and you're joined by the experienced corporate veterans, then I think we're going to see the type of markets that are ripe for the types of investments that my bank would want to come in and invest in.
Yes, and why the majority of your investments so far have been outside of Southeast Asia? You do invest in funds. So what is the thesis behind the fund of funds model?
So I think a lot of it was, again, we're a first-time fund. We've been doing corporate venturing for just over 3 years, which compared to Thailand, we're actually veterans, which means that the great majority of CVC funds have been doing it for less than the cycle of a new iPhone. So for us and especially if we're going to go global, investing in funds when we're new to VC and we're new to some of these technologies, fintech, cyber, blockchain, whatever, it made sense for us to look for key players in some of these markets. So, if we're looking at, say, New York, we're looking at London, we're looking at Israel, markets that have a lot of the technology that we would ultimately need. But we're new to these markets. So we're doing the deep dive ourselves, but sometimes it was helpful for us to place capital with very, very experienced players who can curate a lot of this deal flow, introduce us to players in the market, hopefully make us some money in the meantime. But we're now at the point where we've invested in several funds and key outposts around the world, and we're now starting to shift more towards direct investment. Now that we have the level of comfort, the network in these markets, we're no longer just babes in the woods.
This is a question for IDT. So. As Grab Ventures has invested in a few companies, but also at the same time, Grab has also acquired some regional startups. And so, do you think that the model of CVC would block the way for the startups to not really block the way, but make it harder to raise the next round of funding? And does that create any challenges for you in terms of sourcing the deals? And to grow the startup further?
I think, as I mentioned, the one simple way to avoid any such challenges is to invest a lot of time and diligence upfront. And the startup founders are also doing a lot of that. Bringing in strategics like us at the right stage is quite important to avoid any such challenges. Spending a lot of time upfront really helps. One way we do it is through our Grab Ventures Velocity program. So Grab Ventures Velocity is a very important channel for us to source strategic investments. And the program is meant essentially for that, to know the startup founders much better, to know their operations much better, and to build that comfort level that within a reasonable time frame, whatever we do together, either as a deeper partnership or an investment, can create a meaningful value for both sides. So that would be the best way we see to avoid that challenge.
And for Paul and Semin and Andre, do you also make like majority investment in through your fund? And then how meaningful is it in this region?
I'd like, but look at the valuation of the Indian companies, right? So who will have money to have majority unless you come very early? Now we come mid-stage, and like we try to write a first check in Series B, and then like we should make at least 5x in 5 years. That's the way how the system works. It's mainly consumer internet companies, and like we need a leaders. We're very tough in our sourcing because we want to contribute, but building up a leader. I don't buy this argument that like India is big and like too many companies can survive. You need a leader because liquidity issue is still there. And unless you don't have a leader, it will be a problem for you then to sell the company. But no, we cannot afford majority coming to B, right? So we should make alliances with people, but we already know the whole market who can contribute, who understand risk management, who understand marketing, who can bring Chinese or Korean or Japanese investors. And usually the way how it works, it's like a pool of guys. And this pool has majority. That's the way how it works. But like only us, unfortunately, I cannot. I'd like to.
Yes, Semin.
I mean, Rakuten Ventures has evolved over the years. I mean, we definitely had situations where we were the only investors, and running the fund for 6 years, there are definitive, real advantages for being very few on the cap table in terms of pricing, in terms of hedging risk, in terms of influence, and also being able to develop the right exit strategy in close partnership with the management team. But definitely, as we've built out the fund and our portfolio, there's so much more overarching value in developing a diverse cap table from diverse regions around the world. So definitely, it's a mandate for us to make sure that we have a great team of investors helping out the companies. And indeed, we spend an inordinate amount of time trying to get really value-added leads onto, not leads, but again, co-investors onto the cap table.
Because we are about to run out of time, so let's move on to the exit topic. So it's quite early for this region, and you also started invest like 5-6 years ago. And so how do you map out exit for your portfolio? So Semin, so you already have exits?
Yeah, I mean, we've had like 3 or 4 exits already that happened. Like, we have a company in San Mateo called Polymorph that was acquired by Walmart because they wanted a next generation ad tech company. We exited out in Japan in a company called Makely. It's a cloud invoicing company that was acquired by Ricoh, the printing company. There was a company called Geno Taxi in New York, which was acquired by Get Taxi later on. But as you can see, our strength is being able to invest anywhere so that we can develop a very good basket of assets and hence risk profiles. So and with that we also bring in very cross-pollinating benefits. The companies that we've invested and the technologies that we've invested in the US directly apply to some of the portfolios in Southeast Asia and vice versa every single day. So in many ways, not necessarily the synergistic advantages of a corporation, but when we invest in companies, in my mind for Rakuten Venture, we're building our own company so that intra-portfolio synergies can happen readily.
And Andre, you also have the recent exit. So do you see that exit for corporate VC funds are still through M&A?
Exit is exit. Wherever you can sell the company, sell it if the valuation is right for you, right? So yes, we are doing a lot. It's one of the soft money value you bring to the table, so people know that you are good in finding their buyers, and we're looking buyers for our companies. Like we have 10 companies in the portfolio, 3 already coming to $500 million valuation-wise. So there will be, hopefully, as everything is okay, will be unicorns. We start looking around. But usually, like I remember what we promised in IC is exit opportunity, and what actually exit happens to different things, right? So I mean, like we sold their very good gift solution companies, which is market share in India was more than 90%. It's an excellent company. And we sold it to a point of sales company. It was going to adjacent area. Yeah, not just to the companies which we put as a strategic so-called buyer. So what the idea is, if you call an M&A, usually look at the table and say, listen, you build up a good business, and then somebody like a global company will come, US, European, wherever, Australian company will come, it will be easier for them to buy this company and to start from scratch in India. Yeah, so that's actually the way how I'll do it. In an IPO or secondary, whatever it is. So it's, you should look around all the time, because it's very different. You look at the corporate strategy of some very strange businesses, because eventually it can happen that will be your future buyer.
Yes, time is about up. So I have the final questions. I remember Paul and I once had a conversation about like CVC is not necessarily the only path for corporate to innovate and to make investment. So Paul, are you still keeping that advice? And for the others, if there is a corporate here that are looking to launch a CVC fund, what are your advice? So let's begin with
No,
Paul.
I mean, I think the point still holds. I think when corporates want to engage with innovation, I think they should be asking themselves what they want to accomplish. Because CVC is a tool. Accelerators are a tool. Incubators, venture builders are all tools. Figure out what you want to do and then pick the right tool for that. I do encounter a lot of corporates that they form a CVC, they seed it with funds, and then they sit there and say, well, what do we want to do with it and what should our strategy should be? It's cart before the horse. So I always tell corporates that ask me for advice, what do you want to accomplish first? And CVC might be the right tool, it may not be. It might be a combination of tools. So, it shouldn't be the starting point. It should be just the facilitator for what the company wants to do.
Yes, Samin, let's hear from you.
I mean, in many ways, innovation and technology in this day and age is commoditized. 99% of the technology that you're looking at for a startup, you can get your hands on in an hour or so. It's the thing that's not commoditized here is agility. But at the same time, as a CVC, you really need to know what you want to be. Look at what Tencent does, SoftBank does, even Naspers does, and to an extent Sistema does. There is much strength in being able to utilize investments as a net capital gainer and something that makes your company's balance sheet stronger. Tencent, 1/3 of their net income gain is from investments. SoftBank, 1/2. This is a tool that's wielded correctly with deference and judicious intellect. This is where a CVC becomes very, very powerful. So was it for Intel, so was it for Qualcomm Ventures. So I think in many ways, be what you want to be, but be very committed towards it. And I try to say this to a lot of the other colleagues that want to become CVCs. Investment is not a privilege, it is a profession. So don't come up to me and say, oh my God, I bled and died for this company for 20 years, now I can do investments. Don't give me that shit. So, that's the first time somebody said shit, right? But that's the thing, right? Be true to yourself, and if you can commit that manifestation into an action, that is where your alpha comes from.
Yes, Aditi?
Quite in line with what Paul and Simon said. I think CVC is not fairy dust. So one is knowing that to start with, what are the objectives, and then picking the right operating model for that. And then once you commit to a model, then quite rightly, like go all in, fully support it, commit to it.
Yes. Let's come to you, Andre.
I think if it's a real idea of bringing this management expertise, it can be a good solution, right? Because eventually it's coming to the table as the board is sitting and don't know what to do, right? And if you have an access to your expertise at home, I don't do due deal without a call back to my guys, who are working in different ball game, but they say it's not doable, they cheat you. So they check it again, So this kind of thing maybe will help to all LPs. Our LPs will never invest in either through us. Yeah, so it's not other game, They will not come alone because they're scared. A lot of people scared of very different investment destinations. So say like, listen, we'll feel more comfortable sitting on your back, right, and you do it through you. If it's like continuation of their strategic, it's less interesting because it's not like cricket, yeah? It's not business, right? So nobody understands what you're doing, what the strategic guys tell you to do, right? Then it will be scary. If somebody comes to us and saying, listen, guys, are you strategic or not? If you're strategic, if you are not strategic, then it will be a problem as you asked the question about, to have you in the cap table, because who will come if you are sitting already here, right? I mean, like, this very much, it's all nuances, it's all gray, yeah? So, and to do it properly, it's like actually the biggest task of the manager of the fund, right? Because you're under pressure from everywhere and you should find the way out, and the right way out. But if you do it properly, it's a big, big advantage to sit with guys with expertise, you know, to have these guys in the cap table.
Thank you. And that's the wrap up for this panel today. Thank you for listening to us. Thank you, panelists.
Thank you very much.